UK voters have voted on Friday to leave the EU, which has subsequently created a lot of volatility in the markets. Here's our take. UK voters' decision to exit the European Union has rocked global markets. It may take some time for the shock to work through the economic, financial, and political systems in the UK and Europe. As a result, global stocks may fall further. No two stock market shocks are the same, but in some of the other shocks since the financial crisis, markets have recovered in 3 to 4 months. Investors with longer time horizons may want to maintain their diversified asset allocations, which can help portfolios weather volatility over time. This sort of environment can create opportunities for investors. We are long-term in our focus, and we're very careful not to confuse the local economy and politics with markets. We invest in international and global businesses, and stock prices act as a discounting mechanism. Some of the impacts of the Brexit vote may already be reflected in prices. Against this more volatile backdrop, long-term inefficiencies may emerge. There are great businesses that have been hit hard in the short term, and there are others where risks have increased substantially. This is the type of environment where long-term active managers would be expected to add value. After all, volatility should be our friend over the long term. In fixed income, we continue to look for opportunities where valuations have become dislocated. We have been going through our investment options and exposures, deciding where we want to add or reduce risk. We're not rushing, as we're mindful of challenges around liquidity in the near term. We're largely taking a wait-and-see approach, awaiting improved liquidity. Since the end of the financial crisis-induced global recession in 2009, a series of shocks have helped to keep growth, inflation, and stock market performance subdued. The shocks have taken place in Japan, the United States, and Europe, may offer us some insight into the potential duration of the market impact of Brexit. After the shock of a devastating earthquake and related nuclear accident in Japan on March 11, 2011, the Nikkei fell 16% during the next 2 trading days, but fully recovered those losses by July 8, 2011, a period of 4 months. It is worth noting that the lingering recession caused this initial rebound to fade into back-to-back double-digit declines and rebounds until stocks finally recovered their losses by the end of 2012. After the congressional standoff over raising the U.S. debt ceiling saw the S&P 500 index slide 3% on August 1, 2011, members of the House of Representatives cut a deal that ended on August 2nd, prompting U.S. stocks to a one-day rebound on August 3rd. But they fell another 12% over the next 2 months on fears of economic fallout, finally bottoming on October 3rd, 2011. The S&P 500 recouped these losses by the end of October, a period of 3 months. The European debt crisis forced Spain to unveil an austere budget and prompted labor strikes in Too Big to Bail, Spain on March 27 through 29th of 2012, causing a shock that drove the Stoxx Europe 600 index down 3%. It went on to fall a total of 11% by June 4th as the Eurozone slid into a recession. By the end of July, stocks had fully recovered their losses, a period of 3 months. There are signs to watch that may indicate the impact of the Brexit shock is beginning to lift. First is economic. If the Bank of England and the ECB manage to stabilize financial conditions and the UK and Eurozone economies can capitalize on the weakness in their currencies to ease the slowdown/recession, the economic data may be nearing an inflection point. Second is political. Events to watch for include political referendum announcements in other countries. In fact, over the weekend, Spain's Conservative People's Party won the most seats in the Spanish parliamentary election, but was short of a majority, a result that failed to break a months-long political deadlock, yet it does show that not all EU countries want to leave. Meanwhile, Italy is facing a constitutional reform referendum by October, and France and Germany are holding elections in 2017. Thirdly is currency. Stability may be near when we see an end to the flight to quality, meaning the buying of the US dollar and Japanese yen. Of late, the yen has been the best performing currency at times of heightened uncertainty. The lack of action from the Bank of Japan at its June policy meeting is allowing appreciation pressure to continue to build up. While the yen's move higher is negative for Japanese stocks, which would have moved in lockstep with the yen for 5 years now, an end to the rise in the yen may signal that the worst is over. To sum up, it looks as though the UK's decision to leave the EU could be the beginning of a large protracted process in which dissatisfaction with the effects of 3 decades of globalization is being expressed in ever more impactful ways. It bears watching to see if the trend accelerates and what lasting impacts, if any, these political forces will have on companies around the world. Geopolitical conditions are ever shifting, but great businesses always seem to find a way to adapt and prosper over time. We suspect they will be able to weather this storm. So what should investors do? Short-term focused traders should be prepared for further stock market declines over the next 3 to 6 months, similar to past shocks. We continue to believe volatility will remain a major characteristic of markets for the rest of 2016. However, investors with longer-term time horizons may want to maintain their diversified asset allocations, which can help portfolios weather volatility over time. Staying focused and diversified. In any market environment, we strongly believe that investors should stay diversified across a variety of asset classes. By working closely with us, we can help ensure that your portfolio is properly diversified and that your financial plan supports your long-term goals, time horizon, and risk tolerance. Thank you again for listening. Please call us anytime with any questions.